So over the last quarter, markets have certainly been buoyed by a couple of things. First off, we've got more information in what the US Federal Reserve have in terms of their intentions to start to tighten monetary policy. Hiking rates, the market has a general expectation that they are going to hike rates probably around the middle of 2015. But I think that the market now has a very good expectation that they're not going to be aggressive in that. And they've really taken some comfort out of the fact that monetary policy in the US is not going to be jacked up as much as what people first thought when US economic growth was actually running quite hard. Other parts of the world have also actually provided a lot more stimulus in the form of either quantitative easing or additional rate cuts coming through, and Australia is no exception. And that's really helped equities, particularly yield-bearing stocks, but it's also helped a lot of our fixed income assets as well. One of the major reasons why we think that interest rates are probably going to remain quite low over 2015 is purely on the back of energy prices have dropped dramatically. And it's not just energy and oil, it's really all commodities across the board. So we're in a situation where that's going to really not create any inflation problems for the next 12 months. So what does that mean? It means that interest rates are going to remain low. It means that growth sectors are going to continue to be supported in relation to the fact that there are very little alternatives for investors to put their money at the moment. But that's a risk that we also need to manage. And so we need to be quite careful in relation to that. What happens with energy prices and oil prices? They're not going to go up anytime soon. There is too much production at the moment, which in our eyes isn't going to basically turn the taps off anytime soon. So we're in a situation where that supply is going to overshadow demand and it's going to keep a lid on prices. We've seen the effects that the Reserve Bank in relation to their latest cut in monetary policy has suggested in terms of the inferences that they've provided that there still needs to be a lot more stimulus provided for the Australian economy. The impact of lower commodity prices has had a massive impact in terms of the revenue generating for the country. And that leaves a big hole in Australia's future, not just in its sort of present state, but very much for its future, because really iron ore is one major bulk commodity export, but LNG was going to be the next major export market for Australia. But with gas prices, energy prices halving in the last 9 months, it's a situation where a lot of that investment is being shelved, but the prices that we're actually getting for that future sale of LNG is also under a lot of question mark as well. So that uncertainty plagues the Reserve Bank into sort of thinking that they need to do more on interest rates. They need to get the currency lower. So in their expectations, getting the currency around 70 cents to the US dollar is probably a more stimulatory level than even where it is today. Yes, the currency has weakened, but when you look at where commodity prices are, the buying power of an Australian dollar is still fairly equal to where it was, even when it was at $1 to the US. So that's a situation where the Reserve Bank need to engineer a lower currency, and in order to do that, the only mechanism that they have is really around interest rates. So we do expect probably another 1 to 2, maybe even 3 interest rate cuts, highly dependent on the data that we get over the next few months. So the positioning to take advantage of some of the opportunities that are out there in the market, very much we are sort of looking to increase the degree of foreign currency exposure in our portfolios, either through international equities or through global property. In order to do that, what we're looking for is an appreciation, particularly in the US dollar against the Australian dollar, and we're trying to maximise that opportunity very much so. We're also looking to actually introduce more interest rate sensitivity into the portfolio. We have a lot at the moment, but if interest rates continue to fall, particularly in Australia, then we want to maximise that opportunity even more. So we're actually pushing more money into fixed income, particularly Australian fixed income, in order to access that.